There we are. Well, welcome everyone. It is my pleasure to introduce today's instructor, Ryan Reichert. Ryan is an EA and a CFP and comes to us from San Diego, California. And please join me in congratulating Ryan, who recently passed the U.S. Tax Court exam for non-attorneys. And so Ryan will soon be adding USTCP to his credentials. Ryan is widely known as one of the top tax minds in the country. He is definitely one of the fastest rising stars when it comes to teaching in our industry. And I've had the pleasure of attending Ryan's classes both online and in person. And we were also fortunate to have Ryan present at our October 2025 conference. Ryan is presenting a special mini series for us of 4 webinars in May and June, this being the third of 4. And we're thrilled to welcome Ryan to the NYSSEA webinar series. Ryan, take it away.
Sweet. All right. I'm broadcasting. The PowerPoint's good.
Mm-hmm.
Lovely. Okay. Welcome back, everybody, to our third part in our wonderful series here. Very excited to be back. I had a nice break, got to spend a little bit of time in Italy these last couple of weeks. And so I'm very happy to be back and doing the thing that I love, which is teaching tax, which, it's a great thing. It's a little sad. You choose. Today, we're going to be talking about interesting lives and interesting tax situations. Now, obviously, we've got a very broad topic here. We do have it kind of broken into sections on, like different things that we're going to address. That's me. We already talked about that. We will spend some time talking about this whole classification issue between self-employed individuals and employees, why that's important, mostly for the individual who is trying to decide, like, look, am I supposed to be getting a W-2, or is it appropriate for me to report this income on a Schedule C? Because sometimes you find yourself in this odd position where you're getting paid money, but there's no withholding, but you're still an employee. And so we'll discuss some of that stuff. We're going to talk about the whole discussion on business versus a hobby. When do I get Schedule C treatment? When is it subject to SE tax and when is it not? We will talk about some investment related activities related to day trading and things like that. We'll spend some time discussing startup costs, what's an ordinary necessary business expense, and then we'll close out the last section of this seminar talking about business travel, which is always a super fun, very interesting topic. Now, you'll notice that your handout is about 50 pages long. There's 171 citations, and actually within some of those citations, there are multiple different court cases or revenue rulings or what have you. So make sure that, as I'm going through this, if you're thinking to yourself, wow, I'd like to learn a little bit more about that situation, definitely refer to those citations in your book. So the reason that we're kind of doing this session and the reason that I've been teaching these topics in this particular order is that we live in a day and age where a lot of people are not working a typical 9-to-5 job anymore. Lots of people have side hustles. You're encouraged to kind of, do your 40 hours, but then go out on your last 4 hours of the day and maybe drive Uber or work on your marketing business, or people have all these different types of businesses. And so we end up in this odd situation of trying to apply tax law that is 100 years old in some instances, and applying that to really new issues that we're dealing with in practice. Okay, so the first thing that we got to point out here is that all income from all sources is taxable unless there is a specific exclusion for it. That's code section 61. And it kind of creates for some interesting issues because sometimes people don't get paid in cash. Sometimes they get paid in property. And so we have to consider that when we are dealing with the return. But then, as an offset to that, we may be eligible to claim some deductions, especially if we're operating a trade or business. Now, some of these deductions are going to be things like your travel costs, which would include things like meals while away from the home, mileage, office in the home, self-employed health insurance, retirement plan contributions. So there are some things that are outside of travel. And so we want to know, hey, when are we allowed to take a deduction for these items if they're related to an activity that we're operating? So again, we're taking these old rules and trying to apply it to new situations. And so we're basically taking this, square peg and trying to fit it into a round hole. And so how are we going to deal with this? So the first issue that we want to talk about in the session today is this concept of whether someone is self-employed or they are an employee. Now, this distinction can be made at the federal level, and then sometimes you'll have states that have their own specific requirements, okay? So at the federal level, we historically have looked at this basically control test to see, hey, does the hiring entity have control over the end worker as far as what is the worker's process for doing the things that are hired for? What tools is that person using? Is the worker using their own tools that they supplied, or are they using the tools provided by the hiring entity? Does the hiring entity control at what time that person shows up to work and at what time they go home and all of that fun stuff? And so the more control that the hiring entity has over the worker, the more likely on the federal side that they shift to being an employee. But if the worker tends to have some more control, like the worker can set their own rates, they're using their own process to complete the work, really what's valued at the end of the day is the end result, and they can choose whether or not they want to take on a given job or a given piece of work, then that leans them the other direction to being an independent contractor. And that classification is important, especially now in the post-Tax Cuts and Jobs Act world, where if someone is an employee, they don't get to deduct any of their expenses on their federal return, right? All of those business expenses, those are cordoned off to anybody who is self-employed, but not those who are employees. Now, we've got to be aware of this because oftentimes the hiring entity will misclassify the worker. And so you might have a client who comes in, they get a 1099, or maybe they didn't receive a 1099, but they got cash payments that they're going to report on their return. And so you start asking them, hey, what do you do for work? And as the client starts to tell you this information, everything unravels and you see, this person really should be classified as an employee. The hiring entity has total control over what they do, how they do it, when they show up to work, all of that stuff. And if that is the case, even though the employee or that worker did not have withholdings done on their pay, you would still report that as wages on the return. Then there's a special form that you'll file that allows that person to only pay the employee side of the Social Security tax and the Medicare tax. And there's also another form that you file to request that the IRS make a determination as to that person's employment status. Now, both of those forms have to be filed in that particular instance. And if you read the form instructions, they'll tell you, look, you got to file the report to the IRS to request the reclassification and also the form with your return to say, hey, I'm only supposed to pay the employee share of these FICA taxes, okay? Most of the time, that doesn't result in the IRS actually doing anything, but it's something that you need to do as a part of this process. And so now we are at poll number 1, which is, are you here? Yes, I am here. Do we have any questions so far, or are we doing okay?
Not at this point yet.
Lovely. Lovely. Okay. So just jumping back into it here for our workers who are receiving these payments, if we go through this whole process and we find, look, this person really should be an employee, but they have a lot of expenses. So I'm just going to put the activity on Schedule C. There are instances where the IRS will go in and audit that taxpayer's return, and they will say, no, you were an employee. They will disallow the expenses on the Schedule C, and then you end up paying more tax as a result. So it's something you need to be aware of, and you need to be asking your clients about the nature of the work they're doing for whatever their hiring entity is. Okay, now when we swing to the side of independent contractor, right? Now we've got to check to see, is this independent contractor engaged in a trade or business? And if they are not, then they're going to have different tax treatment, which we'll talk about in just a little bit. Now, in order to be a trade or business, two prongs of this test have to be met. The first prong is that the taxpayer is involved in the activity on a continuous and a regular basis. And then the second requirement is that the taxpayer is engaged in that activity for a primarily for profit motive. Okay, it's got to be the primary motive must be profit, and it cannot be something like a secondary or a tertiary motive for doing the work. Now, if you don't fall under this trade or business classification because you don't meet both prongs of that test, now you fall into this hobby category, right? And everybody knows at this point, we've covered it in the last two seminars, hobby treatment is not ideal because you've got to report all of that income on your return, but you don't get to deduct any expenses because those are all hobby activities, are hobby expenses, and those would be deducted as 2% miscellaneous itemized deductions, which on the federal return are not deductible. Now, the one exception to this for a hobby is if the taxpayer is operating a hobby activity and they have costs of goods that are sold. If they have cost of goods sold, they are allowed a deduction for that amount. Now, the instructions say that what you do in the instance of having a hobby is you take your income from the hobby, you directly subtract the cost of goods sold number, and that's the amount that goes on Schedule 1, line 8J for the not-for-profit activity income. I know a lot of people don't like to do that because they want the amount on the 1099 to show in income on the Schedule 1 so the IRS can easily match it up. And so I see people all the time just report the 1099 amount in that hobby line and then deduct the cost of goods sold on 8Z as a negative adjustment. Okay. Now, even though we have this distinct disadvantage to being a hobby activity and not really being able to deduct our expenses, the one advantage that we get is that the activity is not subject to self-employment tax. Now, this can be helpful sometimes where a taxpayer is receiving these payments as a contractor, but they don't have really any expenses. And if that's the case, they might get better treatment by calling it a hobby activity if they qualify to do so, because now, yes, they're still reporting the income, but it's not subject to self-employment tax, which can result in pretty good savings. Now, the other downside to hobby activity treatment is that it would not qualify for the QBI deduction. So something else to be aware of. All right. So when we look at our two-prong test, let's start by looking at the prong for, is it primarily for profit? Now, there's 9 factors that the courts historically look at, and now these are the 9 factors that the IRS also uses when they are checking to see, look, is this activity a hobby or is it a trade or business? Is it primarily for profit? So they look at the way the taxpayer conducts the activity. Are they keeping books and records? Are they doing things in a business-like manner? Okay. They look at the expertise of the taxpayer and their advisors in that particular space. They look at the time and effort spent on the activity, the expectations that the assets might appreciate in value, the taxpayer's success in similar or dissimilar activities. They look at the history of income, the amount of the profits, and the taxpayer's finances. Because if somebody is a billionaire and they're doing this little activity on the side that's making them, I don't know, like $100,000 a year. To some people, $100,000 a year might be a lot of money, right? But to someone who's a billionaire, $100,000 might not mean anything at all. And I'm just kind of giving you, a really far out there example just so you can get an idea of how they apply these rules. They also look at elements of personal pleasure or recreation. This factor is really pushed deeply on when somebody is operating an equestrian business. So if I'm racing horses or breeding horses, but really like my kids just love horses, oftentimes that will stop the taxpayer from being able to treat that activity as a trade or a business. And the same thing when we look at recreation, that can also be problematic. So you just got to watch out for that. Okay, on to the regular and continuous prong. So regular and continuous. If you have something that is sporadic, meaning it's done sometimes, but you don't really know when it's going to happen, it's very random, that is not regular and continuous. So a sporadic activity is not a trade or business. It's going to get hobby classification on the return. If a taxpayer has another job, that might be considered in kind of pushing them out of trade or business territory, but it's really going to depend on the facts and circumstances. And again, we have lots of court cases that are in your book that kind of show you, which way it can go. And we're going to look at some examples here right now. So in our first example on page 3, we've got aspiring author aspiring author who worked at Intel. He had a marketing background and a master's degree in business. He took a 4-month international trip using his vacation time. He outlined a business plan to write and self-publish a book about his trip. He took about 4,500 photos and maintained a journal while traveling. 5 years later, he had not completed or published a book. Can he deduct the travel expenses? So there are a couple of things kind of going against the taxpayer in this particular instance. And the thing that you'll find is that a lot of these examples, the court really will kind of pick the easiest lane to go down to either disallow or allow a particular item on the return. And so we'll only get commentary on that one item. Here, the court kind of ripped apart the regular and continuous portion of this, and also the for-profit. I would say that they could have done it either way. Here, they're basically saying, look, you have no background as a writer. You weren't engaged regularly and continuously in the activity. You did this trip 5 years ago, and you haven't done anything with it since. There's no published book. There's no profits. There's no nothing. And so they said, look, this is not a trade or business. This is going to be a hobby activity. And so because of that, they disallowed all of the expenses. And the key thing here is that the IRS is always going to have hindsight on their side. And so even though in that year you might think, oh yeah, this is a business activity, if you don't end up doing anything with it 5 years later, the IRS can point to that 4 subsequent or 5 subsequent years and say, look, you didn't do anything with this, and then disallow the expenses on those grounds. Okay, in our next example, we have inventor Eva. She worked on inventing a miles per gallon indicator for automobiles and trucks. She spent 20 to 30 hours a week on this activity. I will do that poll question in just a second. She also worked a full-time job separate from this endeavor. She gave up after a year when she realized the high cost would make it unmarketable, and a major auto manufacturer was attempting to develop a similar device. The question is, can she deduct her expenses as business expenses? So real quick, we have a poll question here. Are you currently in New York State? I am not, though sometimes I wish that I was. You guys have some exciting stuff going on out there. Do we have any questions so far? Are we doing okay?
Still doing okay. Thank you, Ryan.
Wonderful. Love it. So again, the question here, can she deduct her expenses? Now, she's got, oops, I skipped ahead a little bit there. Now, she's got another job doing some other type of engineering work, right? But the courts looked at this and they said, you spent during that year a ton of time trying to figure out how to develop this miles per gallon indicator. And you conducted it in a business-like manner, right? You spent 20 to 30 hours a week on the activity. You had an intention to make a profit. Now, just because you don't end up making a profit at the end of the day doesn't mean that your intent was not to make a profit. Now, people like to throw that around all of the time, but you'll find that there's a really high bar to be able to show the taxpayer's intent in instances like this. But here the court said, look, you did conduct it in a business-like manner, and the moment that you realized that, hey, this was not going to be a profitable activity, you stopped right there and right then. And so again, it's pushing towards the fact that she was running this in a business-like manner, and so she was allowed to deduct those expenses on her return. Okay, Free Time Francis requests a rebate on the shampoo she always uses. The company then emails an offer for $5 if she completes their survey. She completes the survey and receives the $5. How is that reported on her return? Now, is she an employee of the shampoo company? Absolutely not. So we go to the independent contractor side, and now we check to see, okay, is she operating a trade or business, or is it a hobby? Is this something that she does primarily for profit? Maybe. Is it regular and continuous? No, it's not. So it's going to fall to that hobby side, and this is just going to be $5 of income on Schedule 1, Line 8J for activity not primarily for profit. Now, in reality, how many people are going to tell their tax professional, oh yeah, I got $5 from this rebate from the shampoo company? No one's going to tell you about it. But this just helps to kind of illustrate the point a little bit. Okay, now what if instead of getting $5, a whopping $5 in cash, she gets a free bottle of shampoo worth $6? Well, again, provided she tells you that she did the rebate program and got a $6 bottle of shampoo, that would be $6 of ordinary income, Schedule 1, Line 8J. She's not operating a trade or business, and so it's treated like a hobby activity on the return. Okay, feet pics. Francis's family is short of money. Francis decides to seek out money-making opportunities on the internet. She begins selling pictures of her feet every single day. The total value of the goods and cash she received, because obviously it's not just cash, people are sending her gifts, is $11,000. How is that going to be reported on her return? Now, this is usually way more fun when we're all in person and we can laugh about feet pics, but this is the reality of the world that we live in now, right? People sell stuff online. They sell crazy things. OnlyFans is a big thing these days. We talked about that with the tips deduction at the conference, I think, last year. But here in this particular instance, we'd have to check to see, okay, so Francis is an independent contractor. She is self-employed, potentially. So the question is she operating a trade or business, or is this a hobby? Now, her family is short of money. She is seeking out money-making opportunities, and she made 11 grand by selling pictures of her feet on the internet. It's primarily for profit, and it's regular and continuous because she's doing it every single day. Now, I could see a world where Frances has another full-time job where she's making $70,000 or $80,000, and they say, maybe selling your feet pictures online is a hobby and it's not a trade or a business. But in this particular case, we're going to say that it is a trade or business, and so she would just report it on Schedule C, and it would be subject to self-employment tax. How fun is that? Okay. So in your book, there are a variety of, interesting lives that we could kind of discuss and dive deeper into. And you'll notice that on page 5 in your handout, each one of these bullets in interesting lives to discuss actually has a citation after it. And so all of these 5 bullets, and actually a few more, are all court cases that you can go and read. If you're trying to, kind of ride this line of, is it a trade or business or is it a hobby? So one of them was the sale of excess furnishing from property purchased for personal use. This was determined to be a hobby activity in this particular case. Someone selling vitamins and protein supplements. So lots of people do that in their free time if they're really into supplements. They might, get into one of the multi-level marketing schemes and start selling this stuff to their friends and family. Now, if they're only selling it to friends and family, and they're really just doing it to get discounts on their own products that they want to purchase, that's probably not a trader business because it's not primarily for profit. But if they were selling multivitamins and protein supplements to anybody who would listen to them, that might start to be more of a trader business. A lawyer handling their own family member's business. So is that person being paid they're like what they would be paid as a normal attorney to do that work? Same thing with a real estate agent working only for family and friends. Are they getting paid what a real estate agent would really get paid? You would also look at things like what other work is that person doing? Selling insider information one time or repeatedly. Now, this was a really, really interesting tax court case where a taxpayer worked at an investment bank, and he was also selling insider information kind of like on the side. And so he got indicted by the SEC, and he had to pay all these fines and these penalties, but he also had expenses related to the sale of insider information. And so he went back and amended his return to claim those like expenses for selling insider information on his tax return like it was a trader business. And the courts disallowed it because they said that it was not regular and continuous enough to be a trader business, which was very, very interesting. So lots of interesting lives that people run. And I just want to point a couple out to you. Okay, going more deeply into the regular and continuous, if you've got to take a temporary hiatus from doing work, when you resume your activity, the expenses to actually get it reset up and get it going again would not be deductible, but you can have these periods where you do have a little bit of a break. You also have instances where the taxpayer may be working but does not have income. Now, this is an interesting case. Do I have an example about it in here? I do. Jewelry salesman Jerry lost his relationship with the manufacturer that he represented. He actively sought another position that would let him continue to service his jewelry customers. He continued to correspond with and entertain buyers for establishments that he had done business with in his 24 years of selling jewelry. So the question is, if he doesn't have any product to sell his clients, but he's actively trying to find a new provider and he's actively trying to kind of solicit and work with and keep his relationship with his clients, can he keep deducting his expenses during that period of time? And in this particular instance, the court said, yes, you can, because you were still doing work. You didn't stop running your jewelry business for a couple of years and then decide to get back into it and restart. You were actively working during the time that you were not making any income. So that was totally fine in that particular instance. Okay, expenses to preserve work. We have in this example, and again, this was a court case, we've got attorney Alice, who was employed full-time by the Department of Justice. Now, the Department of Justice has a special regulation that says if you are in the DOJ, you cannot have a private law practice except in very, very limited circumstances, which do not apply here. And so she kept incurring expenses to keep her contacts and to try to kind of, get future work lined up so that way she could re-enter into private practice at some point in the future. She did about 50 to 100 hours of that kind of like hobnobbing work, making sure she was meeting new people to have new clients after she left her job at the DOJ. But she did not hold herself out as engaged in the private practice of law while she was doing that, except for the fact that she had business cards that were printed for distribution. She didn't do any advertising outside of that. And so the question was, is this still a trader business for Alice if she's working for the DOJ and she's prohibited from having her own private practice? And the answer here is no. This is a hiatus. It's not working but no income. And so for that reason, the court said, look, you're not going to be allowed to deduct your expenses during this time because you legally were not allowed to operate your own law practice. Okay, expenses from a former business activity. So if a taxpayer is running their business, We've got another poll question. Are you still with us? Yes, I am. How are we doing on questions? Do we have any so far? Are we just
Doing
cruising?
such a great job that no questions so far. You're covering it.
Wow, amazing. Okay. So for a former business activity, if we've got a cash basis taxpayer, they can still continue to deduct expenses into the future from that old activity. And the most common place that we see this is with something like tail insurance. Okay. So in this particular example, we've got Dr. Dan. He retired this year, but he's got to pay insurance premiums for 3 years to cover acts while he was practicing, because once you get to the end of that 3 years, that was the end of the statute of limitations for medical malpractice in his particular situation. So the question is, can he still deduct these insurance premiums even though there is no income? And the answer is absolutely. Now, this is a really easy question to answer as far as, hey, where do we do the reporting if Dan was a sole proprietor? Because we would just keep filing a Schedule C, and the only item on there would be the expenses for the premiums that he was paying for this particular insurance policy. Now, this gets vastly more complicated when you've got Dan operating as an S corporation or as a C corporation. And the truth is that I couldn't tell you what the actual answer is going to be because it's never been litigated before, and I haven't seen any guidance on it. My thought is that Dan would probably close out the S corporation, though I could see a world where he has to keep it open for that 3-year period for the insurance to still be in play. If it is open, you would just deduct those premiums on the S or C corporation return. If you close the entity, again, that's a little bit more tricky. Can we say that the income or the expense really should have been an ordinary expense, or would it be capital because it's a contribution into an entity that you're not going to recover? I don't know. It's a good question. Don't have an answer for that. Okay, so let's go a little bit more deeply here into our primary motive must be for profit. Now, if you have a personal motive for engaging in a particular activity, now my motive for being in tax is that, I love it. It doesn't bore me. That's a little bit personal, but really it's the money, right? Now, if you've got somebody who's in an activity and they're engaged in that activity to reduce their costs of participation for that activity. Now, again, you'll see this with equestrian businesses where someone is breeding horses or they are racing horses simply because they love to work with horses. And by calling it a trade or business, they're effectively reducing the cost of their participation in that activity. You'll also see this again, like we talked about earlier, with the sale of vitamins and supplements or the sale of Tupperware. Someone might really like those items at a discount, and so they sign up to kind of sell them on the side. Again, if your primary motive for engaging in the activity is to simply reduce your costs, that's not primarily for profit, and you get kicked into that hobby territory. Another one, which is really interesting, is that they say, look, if you're engaged in the activity primarily to avoid taxes, that is not primarily for profit. Now, where does this show up? Well, this can show up with people who go out and they buy into one of these like business in a box investments. And I don't know if any of you have ever heard of this, but I'll kind of explain it briefly here. So a business in a box is where a promoter goes to a taxpayer and the promoter says, hey, I have these batteries. And what I can do is I can sell you, the taxpayer, the batteries, and they're going to be held in this huge facility with all these other batteries that I've sold. You're going to own your couple of batteries, and you're going to receive lease payments for the use of that energy. And we're going to let you write off the entire cost using bonus depreciation, right? And you also get a tax credit and all this other crazy stuff. Well, that taxpayer doesn't know anything about batteries, doesn't know anything about how they work, about leasing energy, about what the costs are, anything about it. So are they really engaged in that activity of buying a battery and having it run by somebody else? No, It's not. So they say, look, that's not a trade or a business. The real reason that you got into this activity was to reduce your tax liability. Okay. So we've got an example for you here in your book on page 8. So in this particular example, we've got a taxpayer. They acted as travel guides using their RV. They led a few international tours every single year, and the agency contracted them for their services. The agency went out and advertised and acquired the customers. The taxpayers set up the itinerary. They booked the accommodations. They did all that work. And they traveled extensively, not serving as guides in years before, during, and after the guided activities. They incurred losses on the guide activities in every single year that they did it. So what's the primary purpose of the guide activity? Is it primarily for profit? Well, in this particular case, the court said, look, you're primarily engaged in this activity to reduce your costs of participating in the activity. You were already doing international travel. You were already on this trip. And you said, well, maybe I can offset some of my costs by acting as a tour guide. That's not primarily for profit. And so for that reason, none of your expenses are deductible. Even though, they had expertise in the area, even though they conducted it in a business-like manner, none of that mattered, primarily because of the element of personal pleasure or recreation. And the courts tend to go heavily into that recreation thing when the activity involves any type of international travel. It's not to say that an international travel business can't be a trader business. It just means that it's really difficult to get it to hold up. Oftentimes it gets reclassed as a hobby. Okay, in the next one here, we've got history lover. Oh, we got a poll actually. Have you ever attended the NYSSEA annual conference? Yes, I have. It was wonderful. Do we have any questions or are we good?
Still good.
Oh my gosh. I'm just going to talk to myself for 2 hours. It's going to be great. So we've got history lover who's got a full-time job. They loved searching for and acquiring antiquities. They purchased antiquities and used them in their home, and then they sold some furnishings when they could to make a profit, or they had too many of a particular item in their house. And so the question is, how should this activity be reported on the return? Well, this is not a trade or a business, okay? We can say that it's regular and continuous, but it's not a primarily for-profit motive. The primary motive here is, look, I have too much of this stuff, or look, I want to get rid of this weird antiquity so I can buy this other rare antiquity, and that's not primarily for profit. And so these would either be considered a hobby activity, or they would be, just like sale of personal assets kind of thing. Okay, now we move into the next topic here, which is investment activities as a business. Now, these days, everybody thinks they're a day trader. It drives me absolutely insane when I've got somebody comes in with a consolidated 1099 that's like 500 pages long and they always lose money. It's ridiculous. But a lot of people want to be day traders. And that's because day traders have very, very special tax treatment on the return. But the bar to be a day trader under the code and under all of the case law is very, very, very high. It's very difficult to meet. And so when we look at someone who's an investor, they're typically buying stocks, bonds, securities, investments, and they're holding it for long-term appreciation. Whereas a trader who's engaged in a business is trying to get on the swings of the day. They're trading on speculation and things like that. Those people tend to push more towards the trader side, but it's more complicated than that. Okay. Now, you can have instances where a taxpayer has their retirement portfolio and a brokerage account that they hold for long term, but another account where they do all their day trading and they take on leverage and they have options and shorts and all those things. And you can kind of break out the investment stuff gets investment treatment, the day trader stuff gets day trader type treatment. Okay. Now, why is this so special? Well, all of the expenses for your day trading activity are deducted on Schedule C. And so those will appear there. And so if you're operating out of your home office and you get a home office deduction, great. You got subscriptions you pay for the Bloomberg terminal to do your trades and all of that crazy stuff. You get those on Schedule C. But you know what you have on Schedule C up in the income line is a big fat zero. That's because day traders, all of their sales, their trades are just reported right on Schedule D. So there's no self-employment tax that gets generated for a day trader, but they get to deduct their expenses still against their income on the return, which is, it's a good thing for day traders. They love that. Now, there are lots of special election items that day traders can make, things like mark to market, where at the last day of the year, you basically treat it as though you sold all of your holdings for fair market value. You recognize any gain or loss as a result. That's really complicated. I'm not going to go down that rabbit hole here. I just want to show you the basic tax treatment for somebody who is a day trader. Okay, so again, the sales of securities, even for a day trader, will get capital gain or loss treatment provided they hold for longer than a year. The investment interest limitations do not apply. So most day traders, if they're really into it and they're going to kind of class themselves into that day trader territory, they're going to have leverage in their portfolio, which means they're taking on debt. They have a lot of interest. Normally, that interest is investment interest, and it's limited to the amount of their investment income. But here, for a day trader, it's just going to be regular business interest on the Schedule C. And then we already talked about office and home, so we're not going to go down that rabbit hole any further. Okay, I already mentioned the mark-to-market rules. Again, basically, you treat everything as though you sold it on the last day of the year for fair market value. This election has to be made by the original due date of the return, not including extensions. And if you are filing an extension, then you attach the election statement to the extension when you file that. The election for that, again, really complicated. I would recommend if you have a client that wants to make one of those, that you either spend a lot of time learning about it or that you refer the client out. So how much is enough to be considered a day trader? That's a really great question, and there is not a really great answer. The best thing I can do is kind of show you a couple of different cases and how they played out, and it'll help to kind of illustrate the point. But again, the factors that the courts are looking at is, what is the taxpayer's investment intent? So are they buying and holding for long-term appreciation, or are they trading every single day in a speculative nature? They look at the nature of the income that's derived from the activity relative to all the taxpayers' other income. So if somebody's got a full-time job and they're saying that they're day trading, it's going to be difficult to make that case. Most of the time when somebody is granted day trader status, that is the only thing they do, and they live off of that day trading income for tax purposes at least. And then they also look at the frequency, extent, and regularity of the taxpayer's trades, though the amounts of the trades and the dollar amounts may not always play into the taxpayer's favor. Okay, we talked about what a trader is, what an investor is. These are the core cases that kind of help to define that. Now, here's a couple of examples for you. So we've got a taxpayer who reported 326 stock sales during the year, including some options that were worth more than $9 million. And the court said that this was not sufficient and regular enough throughout the year to have the taxpayer be considered a trader, and so they lost their expenses on the return. In the next example, we have somebody who was a full-time employee as an engineer. They had a lull during their work in February through April, and so they day traded in their free time. And then once they got out of that kind of lull period, they went back to doing their work. And in this particular instance, the court said, look, this is a sporadic activity. It's not regular and continuous. Therefore, we're not going to give you day trader treatment on the return. It's just going to be normal investments. You don't get to deduct any of your expenses. Now, let's go down to the second check mark here, because the first check mark is basically the same as what we've been looking at. In our second check mark on this particular slide, the courts ruled that a taxpayer was a day trader when their entire source of income came from day trading. Now, in this particular case, the taxpayer only had 332 transactions during the year, representing $3 million in value, but he was allowed to be able to be treated as a trader. Even though in our previous example, somebody had more trades than him and was trading a larger actual volume of shares, 9 million as opposed to 3 million here. Again, that big factor here was this guy's only source of income and he was living on it. And so he was granted day trader status. Okay, startup expenditures. You got to be aware of the rules for startup expenditures. If you incur expenses before you're actually able to start selling your product or to start selling your service, you do not get to deduct those expenses until the day hits where you can sell your first item. So any advertising costs or salaries and wages that you paid to employees or anything like that, those are all going to be suspended and held up. When you start your activity, you'll get to amortize those over a 15-year period. You can make an election to potentially deduct up to $5,000 of that up front, and then the remaining amount of the startup costs, those have to be amortized over the 15 years. Okay, and that's what your book says. Okay, if the taxpayer starts their business and they begin to amortize their expenses, and then at year 5 or year 6 or year 7, they decide to close down their activity or they decide to sell it, they get to write off the remainder of their startup costs at that time. If you've got an individual who decides they want to go out and start up a business, there are certain times where if they decide not to start the business, they don't get any deductions. And then there are other times where if they decide not to start the business, then they still get the deductions. And it really depends on, how far into the process are they with their research and their startup costs. If you're just doing general research and a preliminary investigation into this activity, those expenses will not be deductible. But if you got really deep into the process, let's say that I wanted to be a coffee roaster. And so I went to different coffee conferences and I went out and bought a big roasting machine that I was going to put in my garage. And I got, all of this legal stuff set up and insurance. And then my HOA came to me at the end of the day and they said, look, sorry, you're not allowed to roast coffee beans in your garage. And so I went through this whole process. I was really close, but then I had to stop. Then the expenses can still be deducted on the return because I was past the general research or preliminary investigation phase. Okay, so let's talk about ordinary and necessary. So in order for an expense to be deductible, if a taxpayer is operating a trade or business, it's got to be ordinary and necessary in nature. An ordinary expense is one that is customary and usual. It doesn't mean that it's customary and usual for the taxpayer's experience, but in that particular industry as a whole. And then necessary is one that's appropriate and helpful rather than necessarily essential to the business. Now, I got my tax consulting practice and my education company. I have 3 very expensive computers. I've got one at my office, it's a desktop. I've got one here at my house that we're broadcasting from. And then I've got a laptop for when I go out and travel. Now, could I do all of my work from one very powerful laptop? Absolutely. And that would be like my essential item. But it is appropriate and helpful for me to have a desktop computer at each place because if I just have a laptop, it's going to get burned out. It doesn't work as well. It's not as fast as the desktop computers. And so it's appropriate and helpful for me to have the number of computers that I have. When you get into these questions about luxury items, like, the backpack that I carry my laptop in is from Louis Vuitton and I spent $20,000 on it, that may not be ordinary and necessary. And so one of the things that the courts look to is they have this test where they say, look, would a hard-headed business person decide to buy a $20,000 Louis Vuitton backpack to carry their laptop around in? Now, in many cases, I would say no. A hard-headed business person would not make that decision. But I could see a world where somebody is a fancy investment manager. All of their clients are super wealthy. And by having that Louis Vuitton backpack that costs $20,000, maybe you could make an argument for that. But the IRS certainly isn't going to like it. So just be wary of that. Okay, now let's talk about transportation here in the last part of this session. And this is a long section on transportation. I'm talking 30 pages on whether or not travel is deductible. Before we get into this, we've got a poll question. Are you a member of NYSSEA? Do we have any questions?
Well, I have a question, Ryan, actually.
Yes.
I have not worked with a corporation before, like S Corp or C Corp, but a client who started a C Corp last year hasn't sold anything through this year. So if we're tracking the expenses, like, does that work the same way with a C Corp, that we have to track the expenses, but we can't deduct them until he starts in business? And do we just file a zero return for last year then?
Okay, so it depends. Was he able to sell his product and he's just out looking for customers, or was he not ready to be able to sell anything yet?
I believe he was not ready to sell anything yet, like it's a software thing or what have you.
Yeah, if he's not ready to sell it yet because the software is not ready to be able to send it to market, you do not get to deduct the expenses. Okay? So what'll end up happening is, yes, you would just file basically a zero return, with the exception of things like if you have state taxes paid for the entity, those could still be deducted. But virtually everything else is going to either be a startup cost or an organizational cost. So you file a zero return outside of any, state tax fees that you got to pay, and then you will wait until the software is available to be sold. And at that point, you will begin the amortization. I have this pop up. I've got a client who owns 30 different partnerships, and they are all basically, franchisee kind of activities. They're different restaurants and stuff like that. And every time he starts a new restaurant, he forms a new partnership. And I'm like, dude, if you form a new partnership every single time, all of the expenses that you incur for the months leading up to it, and the salaries and the staff and the advertising, you can't deduct all of that stuff until we, go through that 15-year period of amortization. And he just keeps doing it the way he's doing it. So startup costs is just, it's a part of life. It's what we have to deal with. But yes, that is the rule.
Great. Thank you so much.
Yeah, no problem. All righty. So for our local transportation is deductible sometimes. Okay. So when you've got transportation, costs, that's great. The big exception here is obviously commuting costs are not going to be deductible, but there's a lot of stuff that's in between commuting and business travel that's kind of a question mark, which is what we're going to spend this time addressing. Now, let's talk about transportation between two different places of business. Now, this can be deductible, but, oops, where's my cursor at? Commuting, again, generally not deductible. If you've got transportation between the taxpayer's office in the home and another temporary place of work, that travel is deductible under either of the two following circumstances. If they are traveling away from home to the work location, which usually means outside of their metropolitan area, or if they are going to a temporary work location that is in the same field near the tax home. Okay. Now that same field comment is really important because I find a lot of people kind of ignore that. We'll show you an example of it right now. So math teacher Mary teaches at a local high school. Now, I know that Mary is probably an employee and employees don't get to deduct any of their expenses, but just humor me for a second. Let's say that she's an independent contractor of the school somehow. Just humor me. It could be any industry. I chose this one. I get that it's a bad example. So math teacher Mary, independent contractor, teaches at the local high school. She also prepares tax return during spring, and she travels to her clients' homes while she does that. Can Mary deduct the cost of traveling from home to the clients' homes? Now, here we have a problem because Mary's teaching job and the tax prep work is not in the same field. The travel to go from her office and home or from school to her client's house to do their tax return, that first bit of travel is technically commuting, even though it feels messed up to treat it that way. That's because it's not in the same field of work. But once Mary goes to the first client's house for that day, when she goes to the next client's house, that is business travel because that's in the same field of work. You see? Now, if her second job was math tutoring, so she had her office and home for tutoring, she goes to the school to go teach for the day. And then right after school, she drives to a student's house to do tutoring and then to another student's house. All of that travel would be deductible because it's all in the same field of work. Okay. There's a whole revenue ruling on that. It's 1999-7. It's also cited in the book if you're curious. Okay. Now, when you've got transportation between an office and home that's taxpayers' principal place of business and another work location, the travel is going to be deductible regardless of the distance. So in our particular example here, contractor K works at home much of the time. She also visits clients at their business locations. She goes to the hiring company's office every Monday to attend meetings. Can K deduct the cost of transportation from her home to the Monday meetings? Now, this only works if the office is the home office is the principal place of business. And here it is not the principal place of business. Technically, and we're going to get into this more in a little bit when we talk about the tax home, the principal place of business is where you earn the majority of your income at. And for Kay, in this particular case, because she's earning the majority of her income when she's going to the client's locations to be able to do the work for the client, that's where her principal place of business is. And so that first trip from her home to the meeting, that's going to be commuting, but then every trip thereafter would all be deductible travel. Okay. So we've got this chart for you on page 19 that kind of walks you through, like, what if the home is the principal place of business? If it's temporary or regular for the work location, then yes, the travel is deductible, even if you go outside of the tax home, which we'll talk about in just a little bit. If you've got one regular work location, then yes, you can deduct it if it's temporary, but not if it is regular. And then for outside of the tax home, it's the same way. So let's talk about, why this is so important. Why is understanding travel so important? Because when we're talking about deducting travel on the return, it's not just the cost of the miles. It's not just the cost of the airfare. It's everything when you are away from your tax home. It's all of your meals, all of your laundry and your cleaning and your telephone and internet access and temporary office space. All of that stuff becomes deductible when we say that the taxpayer is eligible to deduct travel. So it's a bar that we've got to kind of get over in order to make sure that all of this stuff gets deducted on the return. Now, for some taxpayers, I'm going to show you in this class that they can virtually deduct their entire life because they're set up in such a way where everything that they do is travel away from the tax home. But then there are also other instances where I'm going to show you that this taxpayer is traveling all the time, but they don't get to deduct any of it because they're an itinerant worker, which again, we will define here in a little bit. Okay, travel, determining whether or not it's allowable is still important even for an employee because the employer, if they're going to reimburse their employee for a travel item, if the item for the employee would have been deductible travel, disregarding the fact that we can't deduct it now because of the limitations for the 2% miscellaneous itemized deductions. If the employee would have been able or eligible to deduct travel, when the employer reimburses it, it can be tax-free. But if the employee would not be eligible to deduct the travel, again, ignoring the 2% suspension that we have right now, then it's going to be income to them if they're not eligible to deduct it potentially. And so that's why understanding the bar of where is travel deductible, where is it not, it's important for everybody, even if you're not self-employed. Okay, so before we can get into, hey, is the taxpayer traveling for the purposes of being able to deduct travel, we have to understand what is the taxpayer's tax home. Now, the taxpayer's tax home is not where the taxpayer resides. It's not where they live necessarily. The tax home is where the taxpayer's principal place of business is. And as long as the term of the assignment is not 1 year or less, that would be temporary. Or, you could have a problem where the taxpayer does not have a tax home. We'll talk about itinerants in a little bit. Okay, so the principal place of business, again, is the taxpayer's tax home, even if it's not where they actually reside. It is the job, not the lifestyle, that must require the expenses in order for them to be deductible. And the surrounding area or the metropolitan area around the taxpayer's tax home is also considered to be a part of the tax home. Okay, so in this particular example, we've got a student who was going to university in, I believe it's Eau Claire or Eau Claire. I think it's Eau Claire, Wisconsin. But they sold T-shirts at Badger games 180 miles away in Madison, Wisconsin. And the question is, when the student goes from Eau Claire all the way out to Madison, is that deductible travel? Now, in order to show that the travel is deductible, we got to show that the taxpayer is going away from their tax home to a temporary place of work. Where is the taxpayer's tax home? You might look at this and say, well, they're a student in Eau Claire. So obviously, if they reside there, that's where their tax home is, but that doesn't matter at all. Where is the taxpayer's principal place of business? That's in Madison, Wisconsin. And so for tax purposes, that is where their tax home is. And they do not get to deduct any travel when they go from Eau Claire all the way out to Madison. If I said the name of that city wrong for the past example, I'm going to be very embarrassed. All right. Our next example, we've got a CPA who practiced in the Virgin Islands. He took a full-time law course in Miami, Florida, because if you're going to take a law class, at least do it in some place that's fun. He returned on the weekends to the Virgin Islands to look after his practice and business interests. He also rented office space in Miami to do some work there for the Virgin Islands clients. Can the travel expenses be deducted at either location? Now, taxpayer, or in this case, the CPA, they've got a home in the Virgin Islands. That's where they live. That's where all their business is, where their client is. And they're going to Miami to study for law. Now, here's the problem. If they were flying to Miami to work for their tax clients who were in Miami, then that would be deductible because their tax home is going to be the Virgin Islands and they're traveling to Miami for work in the same field and it's temporary in nature. That would be deductible. But the taxpayer is going from the Virgin Islands not to do tax work or accounting work, but to go and get a law degree, which is a totally different field of work. And for that reason, the tax court said none of your travel is deductible. Even though you rented a little office space in Miami to try to say that you were doing, temporary work in Miami, sorry, none of that travel is deductible. So here's a real heartbreaker, but before we do the heartbreaker, we have another poll question, which is, are you paying attention? I absolutely am. It is funny that you put no as the first answer choice. Do we have any questions?
No, but it is pronounced Eau Claire.
I think I said Eau Claire, right?
I think you did, so we're good.
I remember the first time I taught this, it was years ago. And when I put these classes together, I'm just like holed up in a room and I'm just writing. And so I don't get anything out until I go to teach my first one. So I'm in front of a group of like 100 people and I keep saying Eau Claire. And people came up to me afterwards and told me that it was Eau Claire. And so I appreciate that. All right. On to the next one. So this is our kind of like heartbreaking part of the rules that's really like sad and interesting. So let's say that the taxpayer's family has to stay in location A, but the taxpayer works in location B. I'm really sorry, but just because your family resides in location A doesn't mean that's where your tax home is. It's going to be in location B, which generally means that, hey, the travel is not going to be deductible. And the fact that your family lives away from where you work, it doesn't matter if that's because of a housing shortage or wartime restrictions or because of the taxpayer's employer. All righty. So we've got a taxpayer who has a business in a remote area where there were no schools available. We've got the wife and child of the taxpayer who had to live in a completely different state so that way their child could go to school and get an education. And the question is, can the taxpayer deduct the travel expenses to go to the remote site? And the answer is absolutely not. Because the tax home is the principal place of business, which in this particular case was the remote site. And so commuting from your residence to your tax home is not a deductible expense. The next add to this question would be, what if the taxpayer lived a long distance from the job site because he could not physically live any closer? Now, this is interesting because I pointed out a little bit ago that a housing shortage was not an allowable reason to allow the deduction for this travel. But man, the courts do weird things for taxpayers sometimes. And in this particular case, the Ninth Circuit said, look, there was literally not a place that you could live that was close to this job site unless you pitched a tent and slept in the desert. Therefore, we're going to allow you to say that your house was your tax home. That is very rare. You do not see it very often. This is a case that you can look at to check to see what the exact facts were. I don't remember off the top of my head. But sometimes, like I said, the courts do weird things and people have really weird facts. And that's why we have so many citations in this class, because everything is very fact dependent. So find an example that most closely matches your client's scenario. Go read the couple of cases that are attached to that example, and you'll start to get a better idea. At the end of the day, you just got to pass that bar that says, hey, this is more than 50% likely that it'll be allowed. Okay. If you've got multiple places of business, that's me. I've got an office over in Claremont, which is kind of like central San Diego. My house and my home office is up in North County in San Diego. Sometimes I work out at an office in Coronado. I work everywhere all the time. Now, the question for where is my tax home, and it's a little bit easier for me because everything's kind of in San Diego, but the person's tax home, when they have multiple places of businesses, you typically look to see where does the taxpayer make the most money? That's going to be the tax home when they have multiple places of business. Sometimes we will also look at the time spent at each location, but in the vast majority of cases, we look at where do they make the most amount of money. Okay, so we've got an owner of a business who works mainly at a branch office, but they travel regularly to go to their headquarters in another part of the county. They live near the headquarters. Okay, so that's interesting. So they live near the headquarters, but they principally work at the branch office. And then sometimes they do meetings at the headquarters, which also happens to be by their residence. And so the question is, hey, at what location are the expenses deductible as being away from the home? And here, interestingly enough, because the branch office is where they spend the majority of their time working and where they earn the majority of their income. That's their tax home. So when they travel back to the headquarters, which also happens to be right next to their residence, that travel is deductible. Okay. But we have another case where we have a taxpayer that had two businesses. One was away from their home and the other was on their actual property. And he was trying to deduct travel every time he left his home or every time he came back home. And here the court said, look, you have this business at your residence for personal reasons. Even though there happened to be a business there, we're going to say that no, you're not going to get to deduct any of your travel. So again, there are lots of little nuances here when you've got people who are trying to kind of ride the line with whether or not they can deduct travel. So just be aware of that when you're working with clients on this issue. Okay, I already mentioned to you that, how do we determine the principal place of business to figure out where their tax home is? We look at total time, how much money are they making, the level of activity, all that fun stuff. No one factor is technically determinative. We talked about more income. Okay, the nature of the taxpayer's work can make the residence their tax home. I will show you an example of that in a little bit. Typically, when we look at these cases, there are sometimes, again, where the taxpayer's residence might be treated as their tax home because they either have an office and home or they have a business that's right next to where they live. In this instance, your residence is only your tax home if you have duplicate living expenses. So let's say I've got, my house where I've got my office and home, and I primarily work here. This is my tax home. But sometimes I have to go up to my office in, let's say, Orange County. And when I go up there, I have to stay at a hotel. I've got to pay for meals and do all of that stuff. So when I go up there, I still have to pay, my rent. I've still got to pay my utility bills. I've still got to pay all that stuff. And I also have to pay hotel costs and meals while I'm up at the other place in Orange County. And so because of that, I have duplicate living expenses. That's a big thing they look at when they're trying to say, hey, are you allowed to deduct this travel on the return? Okay. When you are trying to deduct travel as being away from the tax home, the job that you're traveling to must be temporary in nature and it cannot be indefinite. Temporary in nature means a year or less. That is a hard line, a year or less. If it's a year and a day, it's not a temporary job. And if you say, I don't know how long it's going to be, then it's not temporary. Okay. Professional athletes, they've got this all the time, right? For a professional athlete, the tax court has said that the tax home of the professional athlete is the city that has the stadium where they play their home games. And that applies to the players, the coaches, and the trainers as well. And so when they go to do an away game, that is travel away from their tax home, and they are allowed to deduct their travel expenses. Okay. They also say that just because here an athlete's contract is for a period of 1 or 2 or more years, that doesn't mean that them traveling to do the away games makes it not temporary. So their travel would still be deductible. Okay. If you have a change in the time expectation as far as how long the job is going to be, and that change kicks you to be longer than a year that you're going to be away from your original tax home, that changes deductibility on that date. And so in your book on pages 33 and 34, I believe that there's an actual example in there that kind of walks you through that, where a taxpayer took a temporary job away from their tax home, which they expected to last 9 months. But then 6 months in, they got word that they were going to have to be there for a year and a half. Once they find out that they've got to be there for a year and a half, it's no longer a temporary work location, and you would not be able to deduct your travel at that point in time. Now, you might think, well, if they originally thought it was only going to be for 9 months, shouldn't they get all the travel costs for the 9 months? But the answer is no. They only get the travel up to the point where they realize that the job will no longer be temporary, which would be starting at the time that they get there up until month 6 when they are notified that, hey, this is now going to be a 1.5-year contract. Okay. So lots of interesting little rules to consider. There's no like special break period as far as like, let's say that, my tax home is here in San Diego, but I work for a large tax firm as a consultant, and they frequently send me to their New York office to do certain jobs. And normally those jobs will be for a period of 3 or 6 months. I might go out there for 3 months and then come back for a month. And then they say, hey, we have a new job for you to come out for 4 months. And then another new job for 6 months. As long as I've got some break in between, it's okay. It's still considered to be temporary in nature. Okay, a probationary period is considered to be indefinite. Again, there's an example of this in your book on page 35 that we're not going to go over here just for time constraint purposes. There are so many examples in the book. This particular example basically goes over a taxpayer who was an airline pilot, and they were going into their probationary period. I think it was like they were going to fly out of like Chicago or something like that. But because it was probationary, even though the guy was only there for 9 months, they said, look, a probationary period is considered indefinite. Therefore, none of your travel to that area is going to be deductible. Okay, itinerant workers. An itinerant is someone who does not have a tax home. They are a nomad of the tax world. And so itinerants, if they don't have a tax home, you can't be away from your tax home. Your tax home as an itinerant is wherever you happen to be at the time. And so this is kind of the worst possible, definition to get shoehorned under, because if you're an itinerant, you don't get to deduct anything at all for your travel costs. And this happens sometimes, right? You've got somebody who is, like a traveling blogger or a traveling vlogger, and they just travel all over the country and they live out of their van. Those people might be an itinerant worker, which means that none of their travel is deductible because their tax home is wherever they are. Okay. Now, typically we're going to want to avoid itinerant status. We'll talk about, how that works here when we see the factors for itinerants. Here are the factors. They are on page 38 of your book. There are 3 factors that we've got to look at. If the taxpayer meets all 3 of these factors, they are not an itinerant, which is a good thing because that means that their travel will be deductible. If they meet 2 of the 3 factors, then the IRS says to look at the facts and circumstances and they'll make a decision. If they meet 1 or none of these factors, then the person is an itinerant and none of their travel is deductible. So let's go through the factors. The first factor, whether the taxpayer performs a portion of the business activity in the vicinity of the claimed tax home and they use it for purposes of lodging while they are there. Okay, I'll give you an example of that in a minute. The second factor is whether the taxpayer's living expenses are duplicated when they travel away from the claimed home because they have to be away for the work. And again, I'll show you an example of that in just a minute. The third factor is broken down, and you can meet any of these 3 sub-items for the third factor, and you'll be treated as though you met the third factor. So the first sub-factor here under item 3 is the taxpayer has not abandoned the vicinity in which the historical place of lodging and claimed home are both located. I am born and raised in San Diego. It is where my historical place of lodging is, and I have not abandoned that area. So I would be treated as though I met this sub-factor here. The second sub-factor for item 3 is if the taxpayer has members of a family, either marital or lineal, that are currently residing in that area. So, maybe you did not grow up in San Diego, but your mother lives in San Diego. And so sometimes you come to San Diego to do work. That could meet this sub-factor. or they use the claimed home frequently for purposes of lodging. So for me, let's say that I start doing some work up in Portland, Oregon. Okay. I don't have any family there. I don't have a historical presence of being there. But if I frequently go back to Portland, Oregon, that's where I tend to return to, then that would meet this third subfactor here. Okay. Now, I already walked over. If you meet all three factors, you're not an itinerant, your travel is deductible. If you meet two of the three, it's facts and circumstances based. And if you meet one or less, then sorry, you're itinerant and your travel is not deductible. Okay, so in our first factor or our first example here, we have outside salesman who has territory covering several states. The employer's main office is in City A. The salesperson returns there for approximately 1 month each year to do some business and for personal reasons as well. The salesman's work assignments are temporary in nature, so none of them are longer than a year. The salesman has no way of knowing where future assignments will be located. They lived in City A for 14 years with their spouse until they were divorced, and now they're living with their sibling. Okay, so this is all in City A. The salesman pays the sibling $50 a month for the room that they're renting out. Now, $50 obviously is nothing today. You got to realize this court case was back from the late 80s, early 90s, so $50 meant a lot more back then. And so they're paying their sibling rent when they stay there. They keep a room furnished for them, and they leave some clothes there as well. The salesman claims City A as his tax home. Can the salesman deduct travel expenses when they go away to these temporary work locations? So what we have to look at here is the salesman an itinerant worker? Which means, do we only meet one or none of the claimed factors? So let's take a look at that. So the first factor is, does the salesman perform a portion of the business in City A when he goes back there? Well, yes, he does. The example said that, yeah, he does some sales in City A when he's staying there. So yes, we meet factor number one. Factor number two, are the salesman's living expenses duplicated at the claimed home when he travels away for business? Well, yeah, he's paying his sibling $50 a month, which at the time was a fair market rate for the room that he was staying in. So yes, he did have duplicate living expenses because he had to pay the $50 to his sibling, and he also had to pay for hotel costs when he traveled away. So we've met two of the three factors already, so we're in good shape. Now for our third factor, is City A where he has a history of lodging in the past? Yes, it is. So we'd be good. We met all three factors there on that first one. Now, it also happens to be a place where, he's got a sibling, but a sibling doesn't qualify because it's only lineal descendants. So that would have to be, or ancestors or lineal descendants, which would be your parents or grandparents or your children or your grandchildren. So the sibling doesn't work there. But again, we had that first sub-factor, so we're good to go. Does he use the claimed home frequently for purposes of lodging? No, because he's only there 1 month a year. But we still met all three of the factors that we needed, so he is not an itinerant. Therefore, when he travels away from City A for work, all of his travel costs are deductible. Okay. Let's say we have the same circumstances as the outside salesman in the prior example, but with the following differences. Let's say that the salesman does no work in City A for any business, and he stays at his sibling's house for 1 or 2 weekends each year, but he does not pay any rent. Now we've got a big problem because our first factor that we met before, if he doesn't do any work in City A now, he fails that factor. And then the second factor is that if he's not paying his sibling rent, then he doesn't have duplicate living expenses. And so we failed 2 of the 3 factors. Now we still meet that final factor, which says, hey, have we not abandoned the vicinity where we have a historical place of lodging? but 1 out of 3 factors is not enough. And so in this case, the salesman would be considered an itinerant worker, therefore none of their travel would be deductible. And so if you've got a client who's in this position, you would just tell them, do some work while you are staying there. Pay your sibling some rent so that way we can show duplicate living expenses. $50 probably is not enough these days to rent a room. Maybe it's $500 a month or something like that. Okay, before we get into this next section here, do we have a poll question? Beautiful. Where are you right now? I'm going to say that I'm somewhere else. I'm at home, but I'm imagining. Do we have any questions?
All quiet for now.
Okay, this is the last 12 minutes, right?
Yes.
I can just bring it home. I can land the plane. Okay, cool. So spouses can have 2 separate tax homes, right? So I'm not married, but if I was, my significant other is a veterinarian. And so, let's say that she primarily works up in Orange County and she commutes up there every day as an independent contractor. And I work primarily in San Diego, but sometimes I do jobs in other places. Now, if I go up to Orange County to do some work, just because it's my significant other's tax home doesn't mean it's my tax home, right? So that's something to kind of keep in mind when you got married couples. All righty. Travel home on days off. Now, I got a great example of this. So when I'm doing brass tack stuff, we do our seminars and we go all the way up the coast of California. And so what we'll do is we'll hit a different city in Southern California every single day for 5 days in a row. We'll spend the weekend up in Ventura or Santa Barbara, California. And then the following week, we go up to Northern California and we hit like San Francisco, we hit wine country, we do Sacramento. And so we hit a couple locations up there. Now, that is travel away from my tax home. But what I like to do is after the session on Friday, I drive 2 or 3 hours back to come back to San Diego to hang out. Now, do I need to come back to San Diego for work? No, I do not. But I want to come home. I want to hang out in my house. I want to see my friends. I want to see my family. And so the question is, can I deduct that travel in the middle to come back home while I'm on my 2-week work trip? And the answer is yes, but my deduction is limited to my cost to stay at that location over the weekend. So if in Santa Barbara, the room cost is $350 a night, and I now don't have to get a room for Friday night and Saturday night, then that's $700 that I could deduct coming back to San Diego, including the meals, including the driving, including all of that stuff. Okay. Okay, retaining lodging at a temporary location while visiting home. Again, same thing. If you've got duplicated living costs, those will be deductible. Okay, there's this question that comes up. Some people are really savvy with their travel plans. They're really into credit card points and all that fun stuff. I recently learned when I was, flying out to Italy and coming back that business class international flights on a Wednesday are way cheaper than they are on any other day of the week. And so I would assume that, some people, when they're doing business, they plan their trips so that way they're leaving on the day with the lowest airfare. Now, the problem with that is that you might have to wait an extra day, right? Stay over on maybe a Saturday so you can get lower airfare the next day. And so you've got additional cost for your hotel for that particular day. The courts have said that that is fine, and they will still allow you to deduct that additional cost of that additional night in that particular instance. The IRS says that they apply a common sense test in a scenario like this to say, look, it makes more sense for me to fly home in a day or two because the rates are much lower. So they'll still let you deduct everything on the way there. Okay. The travel must primarily be for business. It is an all or nothing occasion. If it's not eligible, nothing works. If you are eligible for travel, everything's deductible. All your meals, all your hotels, all your flights, your travel, all that fun stuff. This is why most CE conferences, if you go to a destination location, I'm talking like to Hawaii or the Caribbean or something like that, they'll do CE for 5 hours during the day. Why don't they do the whole 8 hours? Well, because is the reason that I'm going to Hawaii to do a CE conference really for CE? I mean, of course it is. But it's also so I can go out and hang out on the beach and enjoy my time, right? So these CE providers will do like a 5 hour day in Hawaii or a 5 hour day in the Caribbean. So that way, most of the day, the primary purpose of the trip is for business. Now, if that's the case, you're typically going to want to come home right after. Otherwise, you can run the risk of having more days be personal days than being business days. So just be wary of that. If travel is primarily personal, then again, all or nothing, it would not be deductible if that was the case. Okay, let's see here. We've got our final poll question. How many extensions for you? Oh my gosh. How many extensions for you have for the 2025 tax year? I have more than I'd like to admit. We got no questions?
Oh, actually, we do have a question here.
Oh my God, a question.
Mark says that he has a client who sells silver coins and other small retail items, and that his client has lofty goals for business. He is spending way more money in business than he will ever make in sales. Is it okay to tell a client if he doesn't start making money by third year, then we'll need to close the business? How long can client deduct losses before being treated as a hobby?
So again, it's not really a function of how long are you not profitable before you become profitable, right? There are tons of companies that for years produce major losses because they reinvest, they take on new investment, and they spend all that investment on more expenses. So it's not uncommon for businesses to run losses for a long period of time. So I would look less at how much are they losing every year, and I would look more at the factors that we presented earlier. Now, if the guy has a full-time job doing something else and he's making like a couple $100,000 a year and he's selling coins on the side and he's making $2,000 in gross receipts, right? It's a hobby activity. It's just a hobby. And it doesn't mean that you have to close your LLC. It just means that you report it as a hobby activity on the return. And if he's doing coin collecting, then even if it is a hobby, he would still get a deduction for cost of goods sold. More likely than not, they would probably just say it's the sale of collectibles, which is something to be considerate of. I don't know how long he's holding on to these coins before he's getting rid of them, but people need to not look at how many years am I producing a loss and more at what are the factors for, is it primarily for profit and is it regular and continuous? Those are the things that the courts look at, not so much you had losses for 10 years or 20 years or however long it is. Which I know is not the answer you want, but that is the answer that you need. Do we have any others?
Nope, that's it for now. Oh, wait, hold on. Oh, yeah. Mark says thank you.
Okay, good. All right, sweet. Okay, so strict rules for limiting deductions. Oh, goodness gracious. If you've got family members that come with you, this can sometimes be a problem, right? And the example that I like to give as like the perfect example of having your family travel with you is in the case of my good friend and mentor, Lisa Im, who is retired and travels the world and has a wonderful life now that she's sold her education company to me. So Lisa, her husband was an employee of Brass Tacks back when she owned it. And Lisa also had two grandchildren who were also employees of Brass Tacks. And whenever we traveled, they would all go with. And for Lisa, all of that was necessary because her husband was the one that was working with the hotels, that was doing all of the bookings, and the two grandchildren were doing all of the check-in work. Now, I've got to have two employees to do all of that stuff. It's necessary to have those people there. And so for her, she was able to make all of the travel for her family deductible. But there were a couple of key things that had to happen. Those related parties, the spouse, the dependents, if you want to treat their travel as being deductible, typically they've got to be employees. And the work that those family employee members do, it's got to be necessary and not just helpful. Okay, so those are things that you've got to consider. There are lots of examples in your book, and so you want to think about that. I see somebody has their hand up. Is that a question or did
Hey, Ryan, that person has had her hand up for the whole time
the
and
whole time?
not sure
That's
why,
okay.
but we've chatted and asked her whether she needs anything, but we haven't heard an answer.
All right, sounds good. So moving on here, the deductible amount of okay, hold on. Deductible amount of the spouse's deduction is not allowed. So this whole paragraph is effectively getting at this idea that sometimes your spouse just will come with you and they're not doing any work for you, but they just happen to be coming on a business trip. Best example I can give of this is with Shannon Hall and her husband, Noah. So Shannon right now is out in Reno, I think it's Reno, at an EA conference out there. And her husband will go with her to these conferences. Now, if they were to fly to Reno, Shannon would have to buy 2 tickets, one for herself and one for her husband. Now, her husband does not need to come on that trip. And so that cost of the husband's ticket would not be deductible. But when they get there, they stay in the same hotel room, which is the same hotel room she would get even if it was just her. And so because of that, she still gets to deduct the entire cost of the hotel room. If we change that example a little bit and we say that Shannon and her husband drove from Orange County all the way out to Nevada, is Shannon paying more for gas because her husband is in the car? No, she's not. So in that instance, all of that vehicle travel, all that auto expense would be deductible for that trip. So if the spouse coming along doesn't increase the taxpayer's cost, you don't have to do anything to the deductions. But if it costs extra for the spouse to come, that's where you lose just the spouse's deduction because they don't need to be there. And that is it. So if we have any questions, I'm more than happy to answer them. We didn't have a lot during the session. I know there's a lot going on. There's like 50 pages of material to read through. But if you need anything now, I'm here to answer them. And if you want to shoot me an email, I think my email is in the bottom left-hand corner of each page of the book.
Ryan,
I can't hear you. You muted yourself.
My daughter is calling me. Question for you. Let me tell her.
Does anybody else have a question?
Standing by.
I think that was a fabulous presentation, Ryan. Everything was very
Thank
clear.
you.
So
I didn't get attacked by that spider
Ryan,
that I said was in here.
Thank you. This was great because I have a question for you because, I do have a lot of clients with all these businesses and losses, but especially in the film business. And, I recently, my client has been taking losses for years and years and years on his film business. He's been in the film and has all these, and it's, I've been doing the amortization on his costs for the film, but then there's some expenses that he still has, right, outside of those things. So what has happened here? New York State audited him and go like, and the only reason they audited him is because he got married and he had a wife who has an income now. So all of a sudden it's like, oh, wait a second.
Yeah.
Those losses you had didn't matter. But now she has an income. They've audited him, and so I'm currently in the process of going through the audit. But question for you in the terms of how I approach those expenses in terms of because the film, yes, the film was produced. Yes, he's presented it at film festivals, and yes, he's hoping that this film's going to get picked up, right? Because now the film is out there. He's hoping to get it all picked up. So tell me, in terms of the treatment, because there was like a whole lot of expenses. He had to get staff and, pay all these people. And the film is out there, but no money. So
Yeah. I mean,
what's the story here for me?
I think you and I, and like, this is how you got to break it down when you're talking to this person. It's like, okay, we would agree that if the taxpayer is operating a trade or business, they get to deduct expenses, right? And they say, right. And so you say, okay, so to be a trade or business, there's two things that have to happen. It's got to be regular and continuous. It's got to be primarily for profit. The auditor even is going to agree that it's regular and continuous because it's all the guy does. And so now it becomes this question of, do we have a primarily for-profit motive? Okay, does the guy have books and records? Is there actually a chance that one of his films can get picked up? Does he have some sort of plan for how that can occur, right? And you look through, he's got expertise in the area.
Yes,
does he have any success historically selling any films or making any money? I don't know, but that would be a thing to look at. If he has made money at some point in the past on some random film that he did, that would be proof that, hey, I have been successful in the past, but I'm just working on the next success, basically, right? And so you would dial into those 9 factors and you would try to present it in such a way that helps you out. Now, with film, it's going to be a little difficult because there's one factor, that recreation factor, that's going to play against you. And that's what they're going to try to push against you and say, this is just a recreational activity, But if you can argue the other factors strongly enough, then you should be able to get it.
Yeah, it's all he does. That's his expertise. He's went to school for that. That is his thing. And there are some income from certain things like film stuff he shows. He gets money from that. People will view it. He'll get some money coming in, but nothing really major. But he spent hundreds of thousands of dollars in producing his film.
Yeah. Where does the money come from?
Oh, well, he has a trust fund.
Yeah. Okay. So see, but those things can play against you, right? Because when you're looking at profit motive and the 9 factors, the taxpayer's finances is one of the questions.
Yes,
so
I know.
It's a super gray. It's super gray. It's facts and circumstances. I would read some of the cases that we have in the text to see if you can find something that matches a little more closely with what you're saying.
Thank you.
Yeah.
Really helpful. Thank you so much.
Corrine, also, I've done so many New York State audits for musicians with tons of losses, and maybe I can find you something that was successful that would, be comparable.
I would appreciate that. So
Yeah.
yes, we can talk about that.
Yeah,
Thank you.
absolutely.
Yes,
And everybody, I don't see any more questions. I just wanted to thank everybody again for being here. And please watch your email and look at our website because we now have the rest of our webinar series after Ryan's mini series finishes up next week. We've got the rest of our webinars, and have we got a deal for you? The whole series is only $259 for NYSSEA members. So if you're not an NYSSEA member, it's a good incentive to become one. We also offer a discounted price, not quite as discounted, for NAEA members who are not NYSSEA members. That's $399 for the series, and then $499 for non-members or future members. And we've got Ryan, of course, is back next week for the
Yes.
final in our series. But July 15th, we're having Clarice Landreth, EA, She's doing a deep dive into CSED issues. We've got Erin Perry in August, on August 19th. She's presenting on accounting essentials for tax pros. Frank Deegan is coming back on September 16th, tax law research in the IRM. October, of course, you're going to be there in person at our conference in Saratoga Springs. We look forward to seeing you October 25th to 27th. Also, we'll be having our annual meeting, which is virtual. That'll be a special treat with Matt Metras, presenting a free webinar 1 hour on Form 1099 DA Year 1. Then back to the webinars, we've got Larry Pon doing a 3-hour session on Social Security and IRMA issues for tax pros. That's November 18th. And then we welcome Michael Miranda on December 9th for retirement distributions after Secure Act 1.0 and 2.0. And then, of course, in January, we'll have Frank Deegan and Catherine Keene for our traditional federal and New York tax updates. January 6th for Frank, January 20th for Catherine. So we've got lots of good stuff coming up, and we hope that you will join us for some or hopefully all of these things. So thanks again for being with us this evening for us on the East Coast, maybe afternoon if you're further west. And we look forward to seeing you very soon. Thank you for joining, and we hope you enjoyed this really terrific presentation tonight. All right.
Yes, and for those of you who came on late, just remember, apply for our scholarship so you can attend our conference. Free money. We want to give it to you, so don't forget to apply. We want to see you there, and it is not income-based. All you need to have is a desire to come and join us in Saratoga Springs. So have a good night, everyone, and we will see you next week.
Good night, all. Thank
Good
you,
night.
Ryan.
Thanks,
Thank you
Ryan.
so
See you
much.
next week.
Feel better too.
Thank
Yes.
you. I'll try. We'll see what happens.
All right.